For our first topic this week, we want to talk about the Federal Reserve's latest rate cut, or their first rate cut, really, after a series of rate hikes over the last couple of years. We all know about the end of ZIRP and the massive impact that's had on valuations and the public markets, and by flow on the private markets and VC. They've now started switching gears. They had a few moments where they kind of left rates the same, and now they're moving to the cuts, citing slower economic growth, slowing inflationary pressures. And of course, as predicted by everybody and as obvious, the stock market has popped, crypto's jumped up a little, and people are feeling a little better about themselves as if this was some miracle that was unexpected. Yaniv, we've talked on the show a number of times about how ZIRP has affected startups, how public market valuations and the price of money affects valuations in the early stage. It's really, really important, and it compresses valuations all the way down the stream. And so this is obviously very good for startups. Is there anything more to the story than that?
I don't know if there's more to the story than that, but I think first of all, it's really exciting news. I'm not like a fiscal policy nerd by any means, but you would have to say that what has been achieved by the Fed, or whatever you want to say, is actually pretty remarkable, which is that we had inflation really going up and it looked pretty scary. And they have managed to bring it back to where they wanted it without going into a recession, and certainly
Yet.
without going into.
Yet.
Yeah, look, but I guess here's the point. The stock market was close to a record high even before this interest rate cut. So we had a massive ramp up in interest rates from like 0% to whatever it was, like close to 5%, a huge amount of ramp up. And the economy kind of pretty much kept chugging along, cooled a little, which it needed to. That was the whole point of the interest rate rises. But we were in this period of really unnaturally low interest rates for a long period. And what we seem to have done is kind of renormalize them without killing the economy. And now one or two rate cuts, like you said, Chris, people are going to be celebrating it. They're going to feel kind of a bit wealthier again. And it's really good news. And so I think this is kind of the end of the winter. And I would have to say it was a very mild winter. And I know people have gone through a lot of pain. A lot of founders have really struggled to raise capital. A lot of people have lost their jobs and so on. But compared to what it could have been, it was a sunny, beautiful winter. It barely snowed. And now it's spring, the birds are singing. So I think it's really exciting. If you're a startup, if you're a founder and you have seen some traction through the last couple of years of any sort, then this is only going to help. Will there be more rate cuts? I don't know. But increased valuations, people with more money in their pockets, other companies with more budget to spend on stuff, that all starts to unclog the works here. And so, yeah, I don't want to get too far ahead of my skis here, but it is definitely positive news. And I would just feel that just from a sentiment point of view, everyone who's been sitting on the sidelines wondering, that includes VCs, that includes potential customers and so on, is just going to feel that little bit more comfortable to open up their wallet and do the thing. And so it's just really exciting news as far as I'm concerned. I didn't think we would necessarily be here.
Yeah, most decisions lately, it feels like have been kind of no decisions, right? Well, let's wait. Let's see what happens. There's this classic mistake or conflation that occurs, confusing the economy with the stock market. And those are two very, very different things. But yes, the stock market has been strong. And at least in the US, the economy has been relatively strong as well, with unemployment rates being historically low and new jobs being created and so on. I would say in particular on the stock market side, they've benefited a lot, they being the Biden administration in the US, from, I think, the AI surge, right? A lot of those gains have been driven by NVIDIA and Apple and so on. And I mean, again, like you, I'm no expert on these topics, but I'd say the concentration of growth has probably never been higher, or hasn't been higher for a long time. And so those Magnificent Seven are really driving a lot of growth, and that's really driven by the AI speculation and hype and investment, a real investment in that future. So yeah, it's good to see both the stock market and the economy, at least by the numbers, doing very well. But I do think there's this underlying softness that isn't somehow revealed by the numbers. I think the broad stock market is not doing quite as well as the Magnificent Seven. And I think the lived experience of the economy is a lot of softness. I saw this meme on Facebook, I think, of these people with their little open for work badges, but they've been replaced with desperate.
Yeah, I saw that.
That was part of a meme of like being open for work is a sign of desperation. It's a bad signal for employers.
Yeah.
And there's a debate about that. And, we don't want to go into that right now. But it is also touching on this other topic of like, some people are not just open for work, they're desperate for work. And the dislodgement is something about, inflation and rates and whatever, but it's also something to do with automation and an AI and this kind of efficiency kick we've been on, supercharged by Elon's just slashing of Twitter's workforce and Twitter stays running. That was then buttressed by Brian Chesky's founder mode. So, between Elon firing all the people and Brian Chesky saying fire all the product managers, everyone's like, hey, how can we just fire everybody? And so there is a softness, at least in tech, that I think is real.
Yeah, I think you just added at least in tech there. Like that's obviously just one view of the world. There are massive labor shortages in all sorts of sectors that have been there for a long time. But I also just honestly think, Chris, there's this comparison effect. I'm not trying to be unempathetic to the people who are going through real challenges, but I think this is what a normal economy looks like. We had an exceptionally strong economy for a long time where getting jobs was easy, where getting investments was easy, where getting pay rises was easy. And that led to this overheating and ultimately ZERP. And we've kind of hit reset. But the amazing thing is that we've hit this reset and gone back to a normal economy, not a terrible economy. And now interest rates are being cut. I could easily see us getting a bit more of a pep in our step again and really going back to, having some of that softness go away gradually, which is actually the way economies should grow.